Have you ever bought something overpriced, hoping to sell it for even more? If so, you've applied the greater fool theory, perhaps without even knowing it. But what does this intriguing term actually mean? The greater fool theory is an investment principle suggesting that one can profit by purchasing overvalued assets. This is done with the hope that these assets can be resold at an even more inflated price, essentially to a greater fool. So, a lesser fool buys an overpriced asset in the hope of selling it to a greater fool at a later date. This strategy works as long as there are new, greater fools willing to pay higher and higher prices for the asset. However, the market eventually reaches a point where the price is no longer grounded in reality. At this stage, a sell-off can occur, causing the price to drop significantly, sometimes even to its actual worth, which could be nil. The last investors who bought at the peak are left holding the bag, while the earlier, lesser fools make a profit. This process is driven by cognitive biases that lead people to invest in assets whose prices are skyrocketing, even when this is irrational. The herd mentality plays a significant role in this, as stories of early buyers making big profits create a fear of missing out, or FOMO. This effect can lead to speculative bubbles, where more and more investors are needed to buy from earlier investors. Examples of this theory in action can be found in real estate, where investment is often driven by the expectation that prices will always rise. It's also prevalent in the stock market, where investors sometimes make questionable investments, assuming they can sell to a greater fool later. Even the art world isn't immune, with speculation and privileged access driving art prices rather than intrinsic value. While the greater fool theory does exist, it's risky to ignore fundamentals such as valuations and earnings reports. It's crucial to conduct thorough due diligence to understand an investment's fundamental worth and avoid becoming a greater fool yourself. In conclusion, while the greater fool theory can lead to short-term gains, it's not a sustainable long-term strategy. Always remember, the last one holding the bag is the greatest fool.